Hello everyone and welcome back to the sessions on financial reporting. Friends, in this class of financial reporting, we are continuing with the topic financial instruments. This is the fourth lecture on financial instruments. Let me remind you one thing. Past three classes, our major focus was on Ind AS 32. It is from this class when we start talking about the other version of the standard, that is Ind AS 109. So the title for today would be Financial Instruments covered under Ind AS 109. Now, one basic thing that generally a student will always have a question mark as a doubt, that is how come these two separate set of standards. Basically, this version of standard is a newer version, but until the other standard, that is Ind AS 32, gets revised, this one will apply in conjunction with Ind AS 32. So Ind AS 32 also will apply along with this. So how does these two standards parallelly apply? Let us have a brief discussion on this point. If you can see the definition of financial instrument, which we have covered in the first class, financial instrument is any contract that will give rise to financial asset of one entity and financial liability or equity instrument of the other entity. So I have given you examples. If I am issuing debentures and you are subscribing for these debentures, then I am the issuing entity, you are the investor. For me, these debentures will be financial liability. For you, these are investments, so called financial assets. So for me, if it is financial liability, for you it is financial asset. The accounting of financial liability is mainly covered under Ind AS 32, whereas the accounting for financial assets is mainly covered under Ind AS 109. So friends, this chapter when you are dealing with, that is Ind AS 109, the major perspective is from the viewpoint of the investor who is holding financial assets. I am not saying that this standard is totally about financial assets. There is recognition principles of financial liabilities also. Recognition and derecognition of financial liabilities also covered over here. However, the major focus is on the financial asset part. Now friends, when we are starting with this standard, this is again a big standard and it has lots of categories of discussion. So the first thing that we are going to start today is all about classification of financial assets. So how do you classify financial assets? Why do you classify financial assets? What are the principles for which the classification will be considered for all types of financial assets? We are going to discuss these things at length. After completion of discussion on classification of financial assets, we will learn about initial measurement and subsequent measurement of financial assets, and then finally reclassification of financial assets. But let us move step by step. So focusing on classification of financial assets, first thing, why do we need classification of financial asset? Simple answer to that is the treatment, the accounting treatment of different types of financial assets recommended under Ind AS 109 is different. That means if it is a different category of financial asset, a different accounting will be applicable. As a result, you need to first identify, if you are dealing with any financial asset, to which class, to which category it would belong, and accordingly the accounting treatment shall be made applicable. So friends, from the viewpoint of Ind AS 109, there are three categories of financial assets. Financial assets carried at amortized cost, financial assets carried at fair value through other comprehensive income, and the third and last category is financial assets carried at fair value through profit or loss. Now friends, what we have to do is, let us just first write a note about these three categories of financial assets, and then how to classify a financial asset into these three categories, we will learn that as well. So let us write a small note. So please write the heading classification of financial assets, and within that you write, as per Ind AS 109, financial assets can be classified as, number one, financial assets carried at amortized cost. Number 2, financial assets carried at fair value through other comprehensive income, in short FVTOCI. And number 3, financial assets carried at fair value through profit or loss, in short FVTPL. So friends, what are these three categories? How would you make classification? We will discuss everything in detail, but first quickly write it down. Alright friends, you would have finished writing this whole thing. So what are these three categories and how do you classify a financial asset into one of these three categories? Let us talk about that. For this purpose, you should understand one thing very well. The objective, why the entity has purchased a financial asset, why the entity has acquired a financial asset, that objective is of utmost importance. More importantly, we have to also look into the nature of financial assets. So I can tell you one thing, that there could be two possible criterias. One is the nature of the financial asset and one is the objective of the entity for purchase of financial assets. Now one by one, let us talk about these. Let me first begin with an example. Suppose I purchase government bonds which has a remaining life of 5 years, and my intention, my objective is to simply hold these government bonds and keep earning investment income out of that only. Whatever be the interest payments or coupon payments made by the issuing party, that is the government of India, that interest payment and coupon payment is what I would want to sit and earn. I don't want to sell this government bond. My objective is not to sell it. My objective is to retain it. And I would finally encash the redemption proceeds when the bond goes to its maturity. If this is my objective, tell me one thing, market value fluctuation with respect to the value of the bond, I am saying, whatever be the fluctuation in the market price, will that affect me? Suppose somebody comes and gives me a news that this bond what you are holding, its market value has declined. I am not concerned with that. I would have got affected if I was intending to sell it in the near term, correct or not? If the market value has fallen and I am not going to sell that, how does that market value decline affect me at all? I know one thing, that it is a government of India bond and this will be redeemed after 5 years, and this is the amount which has been promised by the government with respect to the redemption value, and I am certainly going to receive it. That means I am not affected with the changes in the fair value of that bond. Think of another situation. If I would have purchased these bonds to earn investment income, and if I get a good price by some party who is a new investor who wants to buy this bond from me, if that party is offering good price, I am okay to sell these bonds. If I am okay to sell these bonds, that means the changes in the market price of the bond will definitely affect me. That means here the fair value measurement becomes important, whereas in the previous example it was not important at all. So friends, I am sure you understand the perspective. Why are we trying to classify the bonds into different categories is because the nature of financial asset and the intention of the entity both are going to play significant roles, and therefore how to classify a financial asset into one of these three categories will primarily depend upon two factors. One which we call as the business model of the entity. Business model of the entity indicates the intention and ability to hold financial asset. I repeat, intention as well as ability to hold financial assets. So that could be what we call as the business model of the entity. So entity, its business model has to be considered, whereas the other factor, the other criteria that you have to consider is the contractual cash flow characteristic of the instrument. That means with respect to that financial asset, what is its contractual cash flow characteristic? Does it have a contractual cash flow characteristic or not? Why are we talking about these contractual cash flow characteristics? I will be able to explain you, just keep patience. My point is, first of all, when I say business model of the entity, it primarily means the intention as well as ability to hold the financial asset. So if my intention is not to retain it for long time and to sell it in the near term, then the first category identified over there is not for me. Then I have to carry the asset either at the second or third category, that is under second or third category, depending upon my choice again, or depending upon some other factors which we are going to discuss. That means the second and third category both are fair value measurements. That means if I am acquiring a financial asset with the sole purpose to sell it in the near term, or I am holding a financial asset to earn its investment income, and when I am getting some good price I am also okay to sell, in either case I have the fair value fluctuations that can affect me. In such case the category of that financial asset will be either second or third. However, when I am simply going to hold the financial assets and I am going to just receive the interest and the principal, only two cash flows, not a third cash flow. I am going to receive only the interest payment and the repayment of the principal. That is what we call as that the instrument or the financial asset has contractual cash flow characteristics. That means if the instrument has contractual cash flow characteristic and I am just going to receive those contractual cash flows, I am not going to receive anything by sale of that financial asset, then and then only I will be allowed to put that financial asset into first category, classified as amortized cost category. Friends, initially it might appear little complicated if you are learning this concept for the first time, but just keep patience. It is very simple. So it's a long journey of lots of understanding and explanation. You just need to keep patience and keep going with me. So I repeat once again, we have two criteria to consider. One is the business model of the entity, which indicates the intention as well as ability to hold financial assets. Secondly, we have also to consider the contractual cash flow characteristic of the instrument. I will talk about these factors once again, but let us do one thing. let us first of all write an important note in this regard. Please write, as per Ind AS 109, the classification of financial assets into any of the above three categories should be made on the basis of both of the following. Number one, entity's business model for managing the financial assets and the contractual cash flow characteristic of the financial asset. So write one more line below that. Business model of the entity indicates its intention and ability to hold the financial asset. So friends, write up this, and then I'll give you one more important note with respect to amortized cost category. But first write what you find on the screen. Alright friends, you would have finished writing this whole thing. Let us move ahead and write the next heading as amortized cost category. So what are the principles of classification of a financial asset into this category? Let us write that. A financial asset shall be measured at amortized cost if both the following conditions are met. Financial asset is held within business model whose objective is to hold financial assets in order to collect contractual cash flows, and the contractual terms of the financial assets give rise on specified dates to cash flows that are solely payments of principal and interest on the principal amount outstanding. Now friends, this is something very important. I have to provide lots and lots of explanation yet on this, but first quickly note it down. Alright friends, I am sure you would have finished writing this whole thing. Let us now go deeper and talk about these concepts in details. So we are talking about amortized cost category, the first category of financial asset. First of all, why this kind of category? For what this kind of category exists? This category exists mainly for such financial assets which are intended to be held for long term till their maturity and then only receive the contractual cash flows. For this purpose, the instrument must have contractual cash flow. Suppose if the instrument itself does not have contractual cash flow, how would the entity receive contractual cash flows? That is why before we will go to the business model test, we will go for a contractual cash flow characteristic test. We will first test whether the instrument has a contractual cash flow characteristic. Some time back I gave you example of bonds, that I am holding bonds. What if I am holding equity share of another company? Can I say that I will get money which is only and only interest and repayment of principal? No. The nature of payment what I will receive as an equity shareholder of a company would be the dividend, would be some kind of proceeds which is not representing the amount of interest and repayment of principal. So friends, the idea is very clear. This has to be some kind of debt instrument. Equity shares will never qualify for this amortized cost category because equity shares of any company will never have contractual cash flow characteristic. So what is the test of contractual cash flow characteristic? How do we know whether contractual cash flow characteristic exists or not? Very simple. At specified dates, if you are getting specified amounts, that is what we call as contractual cash flow. So it has to be cash flows at defined dates and the defined amount of cash flows, and most importantly the cash flows should be comprising of only and only the repayment of the principal. What I have invested in a financial asset, as if I have given loan to someone, I should be getting it back. If I have purchased debentures of a company, if I have purchased government bond, it is as good as I have lent my money and someday I must get it back. That obtaining back is what we call as redemption. The redemption proceeds is the repayment of principal, and the interest in the form of coupon payment or just interest payment will reflect contractual cash flow characteristic. So friends, first thing what you have to look into, whether an instrument has contractual cash flow characteristic or not. And I told you for that purpose what you just need to understand, that the instrument should provide you cash flows which represent interest on principal and repayment of principal. There should not be anything else included in those cash flows. Then we can say that this is, or the instrument or the financial asset is having contractual cash flow characteristic passed. That test is passed. That means contractual cash flow characteristics exist. Then coming to the business model of the entity, because merely contractual cash flow characteristic test passed, you cannot simply put it into amortized cost category. There is consideration for the business model of the entity. You cannot ignore it, you have to consider it. Business model of the entity indicates two things: intention as well as ability to hold financial assets. So let me explain this. I have recently, suppose, purchased some government bonds. So the moment I say government bonds, these will have contractual cash flow characteristic, no doubts about it. Now when you come and inquire about my business model, you ask me, sir, are you going to hold these financial assets till its maturity, till the redemption date? I say maybe, maybe not. That means I am not sure about holding these financial assets. The moment I am not sure means my intention is not to hold till maturity. That means my business model is not open for receiving only contractual cash flow. It will receive contractual cash flow and it is open for receiving other cash flows, maybe by way of sale also. In that case, we would say that it cannot be classified in this amortized cost category ever. So, to bring it into amortized cost category, we have to make sure that the entity's business model is to simply hold the financial asset and just receive contractual cash flows. Suppose I was talking about intention in that example. If I change the dimension of the example, I say, boss, I have 100% intention of just holding these financial assets. I don't have any intention of selling it. I will hold it till maturity. I will receive only contractual cash flow. Now friends, mere intention is also not enough. What is to be looked into is the ability to hold that financial asset. When I say ability to hold the financial asset, what you do is you just look into how did I manage to acquire this financial asset. I have purchased government bond by spending rupees 10 lakhs. You look into from where did I arrange 10 lakhs? When you started investigation into my bank accounts and other records, you find that I have utilized all my liquidity, all my working capital in purchasing these government bonds. That means I don't have a single rupee cash balance available in my cash box or in bank account. No cash balance, no bank balance, no liquid assets, no cash equivalents. I don't have any marketable securities which I can convert it into cash. But I have a big line of creditors standing in the queue for their payments. How will I make payments to my creditors? Obviously, I have to arrange money from somewhere else. Now boss, I have purchased government bond which is giving me coupon payment of 9%. Okay. If I go and borrow money today, I will be incurring interest cost of 15%. I am not going to hold these government bonds which are fetching me just 9% income. I hold them and I borrow money at 15%. It would be a foolishness. No entity would ever do that. Therefore, what will be the mode of arranging funds for payment to these creditors? The only possibility is I will start selling these government bonds. That means I definitely had intention to hold these financial assets, but I don't have ability to hold the financial asset. Then also it cannot be put into amortized cost category. The business model of the entity therefore has to pass both the conditions, intention as well as ability. So friends, that was about amortized cost category. So the idea is once you put an asset into this category, its fair value fluctuation will not affect you because the accounting approach that you follow for amortized cost category itself is titled as amortized cost measurement. How to apply that accounting, we will learn that when the right time comes. But right now we are focusing on the classification part. Let me go to the next stage, that is the other category, second category, financial assets carried at fair value through other comprehensive income. Here also one condition is common, that is the instrument, the financial asset must pass contractual cash flow characteristic test, or in other words, the financial asset must have contractual cash flow characteristic. However, the business model of the entity could be to receive contractual cash flows or to receive cash flows on sale of financial assets. That means when the entity is open for receiving cash flows from the contractual cash flow part or from the sale proceeds of the financial asset, then the business model is not specific, and in such case the entity cannot classify this financial asset into amortized cost category. Then the other category which remains open is the second one, that is financial assets carried at fair value through other comprehensive income. This time the fair value measurement will definitely affect me. But how to do that accounting, we have not started talking about that. We will talk about it, but let us do one thing. Let us first write a note about financial assets carried at fair value through other comprehensive income. So friends, let us write a note about FVTOCI category, that is the financial assets carried at fair value through other comprehensive income. A financial asset shall be measured at FVTOCI if both the following conditions are met. Number one, financial asset is held within a business model whose objective is achieved by both collecting contractual cash flows and selling the financial asset, and the contractual terms of financial asset give rise on specified dates to cash flows that are solely payments of principal and interest on principal amount outstanding. So friends, write up this whole thing. I have already explained to you. We will then move to the third category, but first you write it down quickly. Alright friends, I am sure you would have finished writing this whole thing. Let us move ahead and now talk about the third and the last category, that is FVTPL category. Now FVTPL, it indicates a financial assets carried at fair value through profit or loss. So basically it is a category where the financial assets will always be measured at fair value, and any changes in the fair value will always be routed through profit or loss. Something about this category: this is first of all a residuary category. Any financial asset which could not be classified in the earlier two categories will be classified by default into this residuary category. Secondly, if any financial asset is held for trading, even then that financial asset will be classified under this category, FVTPL category. Third, upon initial recognition, an entity may designate any financial asset under this category without any conditions. So, you have multiple ways of identifying assets that can come under this category, and you have to fulfill any of these conditions. So, first of all, this is the most open category. This category will include literally any kind of financial asset. Means if you want to classify any financial asset into this category, there is absolutely no restriction. You can openly bring any financial asset into this category. And other than this feature, you should understand that 3 criteria have been given by Ind AS 109 for a financial asset to be put into this category. First of all, as I told you, this is a residuary category. Any financial asset which could not be classified under the other 2 categories. Second, if the financial asset is held for trading. What do we mean by financial asset held for trading? We will come to that. But the third point is very important. Upon initial recognition, an entity may designate any financial asset into this category. Now friends, this category is mainly available for all equity instruments. So what happens when there is an equity instrument, it will never be able to qualify the contractual cash flow characteristic. That means if you test whether a contractual cash flow characteristic exists in an equity share, the answer will always be no. Because it does not qualify the contractual cash flow characteristic test, the first 2 categories will never open for equity shares unless in an exceptional scenario, which I am going to discuss at the end. But equity shares will generally be by default classified into FVTPL category, this residuary category, because they lack contractual cash flow characteristic. Now, if you talk about any financial asset which is in the form of a derivative, even that will be classified into this category. But that comes under the main category as held for trading. I have yet to explain what is held for trading. We will talk about it. So I would rather say 2 typical type of instruments would come into this category: investment in equity instruments of another entity and derivative assets. These are generally classified into this category by default because other categories won't open up. Now friends, this is the most open category. Don't ever forget that. I told you literally all financial assets can be brought into this category. So basically, this category will be most exposed to the gain loss recognition, because time to time the fair value changes will be routed through the statement of P&L. That means if there is a loss, whether that loss is realized or not, it will be recognized immediately. If there is a gain, whether it is realized or not, it will be recognized immediately. That means at each reporting date, the prevailing fair value will be the value of these financial assets. So that is why this is the most open category, and there are no restrictions for classification of any financial asset into this category. So friends, I will be giving you some additional points in this regard, but let us do one thing. Let us not jump into multiple things at a time. Let us write up this much note, and then I talk about few very important characteristics of this category and how can, in exceptional case, the other categories can intervene. So let us first write a note. So friends, under the heading FVTPL category, please write: a financial asset shall be measured at FVTPL if it cannot be classified in any of the earlier 2 categories, that is amortized cost or FVTOCI categories, or a financial asset shall be classified into FVTPL category if it is held for trading, or an entity can also designate a financial asset under FVTPL category upon initial recognition. Fulfillment of any of the above conditions is enough. So friends, first write this thing and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and write up some important notes. One point that I have already explained to you and one which is yet to be explained. So this important notes is about equity instrument of another entity held by the reporting entity as a financial asset. So under the heading important notes, please write an equity instrument of another entity is such a financial asset which will never qualify contractual cash flow characteristics test, and therefore it will be classified by default into FVTPL category. However, an entity may make an irrevocable election at initial recognition for classifying the investments in equity instruments into FVTOCI category. So friends, this second point is yet to be understood, but first write it down and then I shall provide the necessary explanation. Alright friends, you would have finished writing these notes. Now let us talk about these things in detail. So here we are talking about investment in equity instruments of another entity. So the point is very simple. These are such financial assets which will never be able to qualify contractual cash flow characteristic test, and therefore by default they will be placed into the residuary category, that is FVTPL category. However, Ind AS 109 provides a choice, but mind it, it is an irrevocable choice. Once you decide to elect it, you cannot change that. So if there is an equity instrument, it will by default come into FVTPL category. But what will happen? The frequent changes in the fair value will have to be routed through profit or loss statement. That means every time at the reporting date, if there is a fluctuation in the market price of that equity instrument, the gain or loss will have to be recognized via P&L. That is the strictness of FVTPL category. The category is open category, but once you put it, you will have to recognize gain loss on a frequent basis at each reporting date. Suppose an entity does not want to recognize the gain or loss which is still unrealized, then there is a choice. With respect to equity instrument, there is a choice. Therefore, if the entity, but only at the time of initial recognition, if the entity makes an irrevocable election of classifying investment in an equity instrument into FVTOCI category, it is acceptable. So this will be an exceptional situation where an equity instrument will get classified under FVTOCI category. What do we mean by irrevocable election or irrevocable choice? Later on in this chapter, we are going to learn reclassification of financial asset. So once you have classified a financial asset into one category, later on it may be reclassified. But that reclassification, understand that reclassification can happen from any category to any category, literally. But once you have placed this equity instrument under FVTOCI category, it cannot be reclassified. Now, one thing has been left over. We were talking about financial assets held for trading, correct? We have yet to understand the meaning of financial assets held for trading. It is very simple. A financial asset is considered as held for trading if it fulfills any one of the given three conditions. I am going to show those conditions over here, but first listen to me. So the first condition is, it is primarily acquired with an intention to sell in the near term. Means it is acquired with an intention to sell in the near term, means in a short term you are going to sell it off. So you have made an investment in any financial asset typically with an objective to sell it in the near term, means it is indication of a very short term investment. In such case, it will be classified under the category held for trading, and anything that comes under held for trading will be by default classified into FVTPL category. Second, you have acquired a financial asset and you have placed that financial asset in a portfolio. That means your intention is not declared, but you have placed that financial asset as part of a portfolio, and such portfolio is giving indications of short term profit making. That means frequently you are making profits on selling those assets of that portfolio, and that portfolio includes this new financial asset. So the moment you have classified a financial asset into such a portfolio, it will by default be considered as held for trading, and then it will be classified under FVTPL category. And last point is, if any financial asset is a derivative instrument, then it is considered as held for trading, and therefore all derivatives which are financial assets will be classified into FVTPL category. So let us do one thing, let us write a note about held for trading and then we shall move ahead. So friends, under the heading held for trading, please write a financial asset is classified as held for trading if it is acquired principally for the purpose of selling it in the near term, or it is part of a portfolio of identified financial instruments that are managed together and for which there is evidence of a recent actual pattern of short term profit taking, or it is a derivative. So please write this quickly and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and take up the next important discussion about initial measurement of financial assets. So after understanding the classification of financial assets into three different categories, you also have to understand how would you measure at the initial stage each financial asset under each of these categories. Now this is very simple. If I can summarize this in just few lines, I would say FVTPL category, it will always be initially measured at fair value, nothing else. That means FVTPL category is such a category where everything right from the beginning till end, all financial assets will be initially as well as subsequently measured at fair value only. There is no scope of adding or subtracting anything from the fair value. It will be purely fair value based measurement. So FVTPL category, it will be fair value. Now let me give you an example. What is the point that I am about to bring? Suppose I have purchased equity shares of a company and the price that I have paid is the market price. That means the fair value. That was suppose rupees 560. On top of that 560, I have paid rupees 2 towards brokerage and other legal and transaction charges. Of course, when I am buying and selling securities, I might have to pay some legal charges, some brokerage, some other type of transaction related cost. So if you can see one thing, from my viewpoint, I have spent rupees 560 for purchasing the equity share of another company, and I have also spent rupees 2 for acquiring the same. So cost out of my pocket is rupees 560 plus 2, that is 562. But if it is FVTPL category, it will not allow me to add that rupees 2 as the initial cost. So the initial measurement will be at fair value only. So what about that rupees 2 that I have spent? That will be simply charged off as an expense in the statement of P&L. So point is very clear friends, FVTPL category, initial measurement, subsequent measurement, everything will be at the fair value necessarily. However, if it is other categories like FVTOCI category, or if it is amortized cost category, then the initial measurement may include such initial transaction cost. In fact, I would say if it is other categories like amortized cost category and the FVTOCI category, then it will always include initial transaction cost except one situation. That exception also I am talking about. So if I remove that exception, and let me tell you that exception is about short term receivables. Keeping aside short term receivables, all other categories, that will be amortized cost category and FVTOCI category, the initial measurement will be made at fair value plus initial transaction cost. So friends, suppose I have purchased a bond which has a market price of rupees 872 and I have paid rupees 2 towards initial transaction cost and brokerages. Now that amount of bond will be measured at the aggregate of the fair value plus the initial transaction cost. So what will happen when it is amortized cost category or FVTOCI category, the initial measurement will be made at fair value plus these initial transaction costs. That is how right from the initial measurement FVTPL category goes differently. So what about those short term receivables? So short term receivables are always measured at transaction amount. That is, whatever be the invoice value, whatever be the amount of transaction, you are always going to measure the short term receivables at that amount. So if you have incurred any expense in regards to that, you cannot add that expense. You will have to charge off that expense in the statement of P&L. Let me give you an example. Suppose you have purchased goods from me on credit and I have incurred expenses to deliver those goods to you. So obviously, to create that financial asset in the form of debtors or short term receivable, I have also spent something, right? That expenditure what I have incurred is a sales or distribution related expense for me. It cannot be added to the value of the asset which is a debtor or a short term receivable, because what I have to collect from you cannot include that component, unless if there is an understanding that you are going to pay for it, I am paying from my pocket and later on you will reimburse, then it becomes part of the transaction. And finally, we would say short term receivables will always be initially measured at the transaction amount. So friends, if I can further shorten this whole discussion, I would say 3 different categories now. I would say FVTPL category, always fair value will be the amount of initial measurement. Short term receivables, always the transaction amount will be the initial amount of measurement. And lastly, third thing, all other financial assets, they will be measured initially at fair value plus initial transaction cost. So if you would want to put it on the same different categories, that is the categories the way you have learned the classification, then first category is amortized cost category. Within amortized cost category, keep aside short term receivables, all other assets will be measured at fair value plus initial transaction cost, and regarding short term receivables, they will be measured at transaction amount. Next category is FVTOCI category. They will be always initially measured, that means financial asset coming in that category will always be measured at initial transaction cost included with the fair value. In other words, fair value plus initial transaction cost. And third and last category is FVTPL category. They will be, that means the financial asset classified into that category will always be measured at fair value only. Any kind of expense in that category, that expense will be charged off to P&L. It will not be added or included with the initial recognized amount of the financial asset. So time for us to write a note on that, that is initial measurement of financial assets. So friends, let us write a note about initial measurement of financial assets. Initial measurement of financial assets other than trade receivables. If it is amortized cost category, it will be fair value plus initial transaction cost. If it is FVTOCI category, it will be fair value plus initial transaction cost. If it is FVTPL category, it will be fair value. That's all. Now what about short term receivables? Trade receivables will be initially recognized and measured at transaction prices. So write this note quickly and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and now talk about subsequent measurement of financial assets. So after understanding initial measurement, the obvious question that would go in someone's mind is how would you subsequently measure these? So again the same thing. If it is amortized cost category, which may include short-term receivables are always exceptional cases. These will always be measured at transaction amount only. For example, if I have sold goods to you on credit for invoice value of rupees 5 lakhs, the initial recognition will be made at rupees 5 lakhs, that is a transaction amount. Subsequently, suppose you have already paid me rupees 2 lakhs, so the transaction amount of 2 lakhs will be subtracted. The balance of the transaction amount is 3 lakhs. I will have to report short-term receivables in your name at rupees 3 lakhs, which represents nothing but the transaction amount. So it is only transaction amount throughout for short-term receivables. Now, if I keep aside short-term receivables, all other amortized cost category financial asset, that means financial assets put into amortized cost category, those financial assets will be measured at amortized cost. Now I have yet to explain you in detail with examples how to apply amortized cost measurement. That you will not follow just by listening to me. We will take a comprehensive example to understand amortized cost measurement. It is very simple, but unless we go into those example situations, you will not be able to just understand what is this amortized cost measurement. But the subsequent measurement of financial assets falling in amortized cost category will be at amortized cost using effective interest rate. That effective interest rate in most cases will not be available, and you will have to determine that. And the idea is very simple. You have made an investment, the IRR of that investment is the effective interest rate. The point is so simple. But friends, I told you, don't bother about this point right now. You will have 100% clarity after solving just one calculated example. Now, other categories. So I told you short-term receivables always transaction amount, amortized cost category where the time value of money becomes a material factor, you will always measure these financial assets at amortized cost using effective interest rate. Now FVTOCI category, the second category, it will always be measured at fair value. Now here it is so simple, the name itself clarifies everything. Can you recall the complete name of that kind of financial asset category? It is financial assets carried at fair value through other comprehensive income. Means after initial measurement at whatever amount you have, at the reporting date you will measure that asset at fair value. Any changes in the earlier carrying amount and the fair value will be recognized through other comprehensive income. That is why it is called FVTOCI, financial assets carried at fair value through other comprehensive income. And lastly, FVTPL category, it is very simple. It will always be carried at fair value. That means financial assets under FVTPL category will be reported at fair value, and the changes in the fair value and the previous carrying amounts will always be recognized as gain or loss through the statement of P&L. So friends, whatever I have discussed, I am going to show the same thing on the screen, and you are going to write down these notes, and these notes will be followed up by a comprehensive example that will explain the subsequent measurement of amortized cost category assets. But let us first write the note about subsequent measurement of financial assets. Amortized cost category. Subsequent measurement will be at amortized cost method using effective interest rate where time value of money is material. Now, what is amortized cost measurement? Interest revenue shall be calculated by using the effective interest method. This shall be calculated by applying the effective interest rate to the gross carrying amount of a financial asset. Friends, I told you that what you are finding, you just have to write down whatever is given on screen. You will take time to understand these two paragraphs. Don't bother about it right now, just write it down, and once we are done with a calculative example, you will definitely follow this. So let us quickly write it up. Alright friends, you would have finished writing this whole thing. Let us move ahead and write some additional notes in this regard. That is about FVTOCI category. Subsequent measurement will be at fair value. Difference resulting out of fair value measurement shall not be recognized in the statement of profit and loss, but will be taken through other comprehensive income. And regarding FVTPL category, subsequent measurement will be at fair value. Changes in fair value shall be recognized through profit or loss. So write up this whole thing and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us now move ahead and take up that example, the calculative example with which we will understand the subsequent measurement of amortized cost category assets. In simple words, the amortized cost measurement, which is given in question number 18. Let us read this question. On 1/4/2012, X Limited purchased 5,009% debentures in A Limited at cost of rupees 1,044 per debenture, which represents fair value on that date. It incurred an additional cost of rupees 1.6 per debenture towards brokerage and initial transaction cost. Face value of each debenture is rupees 1,000. These debentures are redeemable after 5 years, that is on 31/3/2017 at 20% premium. Assume that coupon payments are made by A Limited annually on 31st March and business model of X Limited is to receive contractual cash flows from these investments. Further given, you are required to determine the amount of initial measurement and effective interest rate, interest income to be recognized each year using effective interest rate, and carrying amount of these debentures at each year end as per amortized cost method. So friends, basically what you will have to do is, first if you can go back to the initial part of the question and focus on this last paragraph in this slide. Assume that coupon payments are made by A Limited annually on 31st March and business model of X Limited is to receive the contractual cash flows from these investments. First of all, the nature of investment, if you see, the financial asset which is held in the form of debentures in A Limited, it definitely has contractual cash flows. So the contractual cash flow test is passed by the instrument itself, and the question is very clear in terms of business model of the entity. Business model of X Limited is to receive only the contractual cash flows. That means this company X Limited does not have any intention of selling these debentures. Therefore, these debentures as financial assets can definitely be classified as financial assets carried at amortized cost, and that is why at the later part of the question is asking you to determine the carrying amount of debentures at each year end as per amortized cost method. The basic reason why amortized cost method is applicable is the same, that this financial asset will be carried at amortized cost using effective interest rate. Now the effective interest rate, we have no clue about it. If you can see in this whole question, what is known is the coupon rate of 9% and all the other cash flow information. Now we know one thing for sure, that the effective interest rate will be the IRR of the investment, that is the internal rate of return of this investment, and in absence of this information available, we will have to calculate. So the first thing that you will have to do is you will have to work out the initial measurement and effective interest rate, and let us see how to present the solution. In your solution, what you would first do is write this explanation that financial assets representing 9% debentures in A Limited shall be classified into amortized cost category because the financial assets have contractual cash flow characteristics and the business model of X Limited is to receive only contractual cash flows. Now what we have learnt in terms of initial measurement, for amortized cost category, the initial measurement will be at fair value plus initial transaction cost. Fair value of each debenture was 1,044 and initial expense incurred on each debenture was 1.6. So the aggregate value of each debenture on its initial recognition will be 1044 plus 1.6, and because you have purchased 5,000 units of such debentures, the overall initial measurement will be at rupees 52,28,000. So do one thing, write up this much quickly and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and now determine the present value of cash flows using discounting rates on approximation basis. So we can see one thing, that the coupon rate offered by this investment is 9%, and these debentures are redeemable at considerable premium. So it is implied that the rate of return for this investment has to be little higher than 9%. So we are making a trial using 10% as discounting rate. So what we do is, the remaining life of these debentures is 5 years. So 5 years, the cash flow during these 5 years will simply be the coupon payments, and that coupon payment works out to rupees 4,50,000. Simply 1,000 rupees is the face value of the debenture, 9% is the coupon rate. So 1,000 into 9% would give you rupees 90 as the coupon payment per debenture, and you have 5,000 such debentures. So in total, the cash flow towards these coupon receipts will be 4,50,000. And because this is going to arise on annuity basis for all the years from 1 to 5, you are going to apply annuity factor at 10%, and that works out to 3.790787, and when multiplied to the cash flow amount, you get the present value as 17,05,854. At 5th year end, the debentures will be redeemed at 20% premium, and that works out to rupees 60 lakhs in terms of the total amount, and the present value factor at 10% discounting rate will be 0.620921. Multiplying this, what you get is the present value of that cash flow, and the aggregate present value comes to 54,31,380. Now, because we would want to match this present value with the initial measurement amount, correct? And we find that the present value is higher than the amount of initial measurement. Initial measurement amount, what we have seen some time back, was rupees 52,28,000, and here what we have is a value higher than that. So finally what we would do is, we would now pick a higher discounting rate than 10% to make sure that this present value should reduce. So we are now taking present value at 11% discounting rate. Let us see what we get by applying this. So we have same cash flows what we have recorded in the earlier table, only the present value factors will change because of increase of discounting rate, and obviously because of increase of discounting rate the present value will fall. So now the present value what we get is summing up to 52,23,862, and we finally find that this amount is even lower than the amount of initial measurement, which was rupees 52,28,000. So we can now confirm that the effective interest rate must be between 10% and 11% per annum. So we will definitely compute that rate using interpolation technique, but before we do that, write up these calculations quickly. Alright friends, you would have finished writing these calculations. Let us move ahead and now apply interpolation to determine effective interest rate, which would definitely lie between 10% and 11%. I have already explained you this calculation so many times right from the chapter borrowing cost. I don't have to explain you this again and again. You know the application of interpolation technique for determining IRR, or in this case effective interest rate. So when you apply these calculations, what you get is effective interest rate as 10.98% approx. So write up these calculations and then we shall move ahead. Alright friends, you would have finished writing these calculations. Let us move ahead and now compute the interest and the outstanding balances of this investment at each year end. So this kind of table you have always been preparing, and you know again what you have to do. So year 1, the opening outstanding will be the initial measurement. You will recognize the interest income at 10.98%, which is your effective interest rate, and that comes to 5,74,034, and now the coupon receipt is only 4,50,000. So what you are going to do is, to the opening balance you are going to add the interest income and subtract the coupon receipts, and you will arrive at the closing balance of outstanding, that is the closing balance of investment by end of year 1. Now this balance will become opening balance for year 2, and then you again add 10.98% as interest income for that year and subtract the amount of coupon receipt, that is 4,50,000, and you again get the closing balance. And you will just follow up this calculation till end of year 5, and till end of year 5 the amount outstanding at the end has to match with the redemption price, and that comes to rupees 60 lakhs exactly. One more thing over here, because this 10.98% was an approximate rate, by any chance if you don't get this exactly matching, you should make it up to such an amount that this final value has to be 60 lakhs. So some rounding of adjustments might be required at the interest income in the last year. So friends, quickly write up this whole thing and that will be end of the solution.